please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
You know, finally, the one thing that supported this market throughout, the last several months is the wall of domestic liquidity.
Yes.
Both mutual funds and even PMSs. I mean, we've seen a lot of sort of boutique houses open up and a lot of HNI money also coming into the market. Now, right now, the FI selling continues to be incessant, and we don't know when that tide turns, as and when.
Right.
What's your view on domestic liquidity?
So, if you look at the numbers, the mutual fund inflows, which were about 19,000 crores December, January, are now down to about 11,000 crores. Okay, next week we'll have the June number as well. We'll see what that number looks like. Out of that, SIPs are about 6,500, 7,000 crores. So discretionary allocation is already down 60% from the peak.
So isn't that a big risk?
So, well, that's happened, right? A big part of it has happened. The second is that where are the alternative investment opportunities for a financial investor? I mean, you don't really have great yields even now. You put money at work in a money market mutual fund or even in a debt paper, net post-tax returns.
Bond yields may not be,
sorry?
Bond yields, are, I mean, don't you think they're priced at the point where you can actually make money over the next couple of years?
You don't
if you
know.
lock in
Over the next couple of years, probably. In the next 6-9 months, you don't know. And even if you make money over the next couple of years, net of tax, what do you make? 6.5%, 7%. I mean, you know, that barely, it gives you a positive real return, 200 basis points, 250 basis points, somewhere of that nature. But I think equities historically has been a much more rewarding asset. And you are seeing a shift in allocation. I mean, I'm seeing wealth managers writing to us saying that, oh, you know, we've got this particular structured paper or we've got this bond fund or whatever it is, and this is a nice, interesting opportunity. So, yes, some allocation change will happen. I mean, frankly, last December, last January, you did see this, you know, equities was the only place to go and there was no other asset class. I think, you know, you need a more balanced approach.
Just to take on Surabhi's point, we get the mutual fund number every month. What we don't get is what's happening in
the alternative
PMS
space.
and AIF. And that is now, I was told, a pretty, I mean...
It is a substantial amount, just we don't know.
10% of the MF assets now, which is substantial.
So sorry, how much?
About
10%. I don't know. I don't know the number.
So that's what I mean. So it's not tracked very well.
So my sense
there could be redemptions, etc. There. I mean, there could be a lot of.
There could be. There could be. So
a lot of what we're seeing in mid caps and small caps could also be coming from there. I mean,
but the good news is that at least most of the AIFs that I've had the opportunity to look at, or when we look at our own investors, we go to several pains to explain that, look, these are risky products and you have to have a long-term investment horizon. And I believe most of my peers have done the same thing. The SEBI regulations prevent anybody with less than 1 crore investment ticket getting into these assets, which also helps you cater to a knowledgeable investor class who has the risk appetite and the ability to bear risk. To hold on. So my hope is that people won't react so quickly. Of course, things can change if the macro starts looking a lot worse and the risk off goes to an extreme like what we saw in 2008. A lot of the AIFs are closed-ended. A lot of these are fixed-term products, so you really don't have the opportunity to pull money out. But can something come out? Sure.